U.S. stock futures are pointing to a slightly higher open this morning. However, it does feel like everyone is holding their breath, waiting for economic data and policy signals from the incoming Trump administration.
The markets are definitely in a wait-and-see mode.
We have the job openings and labor turnover survey, or Joel T's data, and the Institute for Supply Management Services Index coming out today.
Those will be important.
Then we have the non-farm payrolls figure due later this week. All of these releases feel more significant than usual.
I think they are.
Do you think these data points hold the key to understanding the Federal Reserve's next move?
Absolutely. These data points will provide a clearer picture of the economy's health. The Joel T's data can tell us a lot about the labor market, for example.
And the ISM Services Index.
That reflects the state of a major part of the U.S. economy. Strong numbers, especially in job growth, could make the Fed less likely to ease up on interest rates.
The 10-year Treasury yield has climbed to 4.6%. That's its highest level since May 2024. This, of course, means higher borrowing costs for everyone, from businesses to individuals. What does this signal about investor sentiment and expectations for interest rates in the future?
The surging yield on the 10-year Treasury is a sign that investors are anticipating higher interest rates down the line. They are essentially betting that the Federal Reserve might have to keep interest rates higher for longer to combat inflation.
Current market predictions suggest the Fed will take a more dovish stance in June. However, they are also predicting rate cuts in 2025. How can both of these predictions be true at the same time?
The market is likely thinking short term. There is a belief that the Fed will want to keep the economy humming along smoothly, especially given all the unknowns surrounding the new administration's policies.
What about the 2025 prediction?
That's more of a longer-term outlook. It's based on the assumption that inflation will eventually be tamed.
Richmond Fed President Thomas Barkin has been sounding the alarm about inflation risks. His warnings seem even more pointed with the Trump administration about to take the reins. How much weight should we give to these warnings in the context of a new administration with a potentially different economic agenda?
Barkin's warnings highlight the potential economic ripple effects of the incoming administration's policies.
Trump campaigned on tax cuts, tariffs, and deregulation.
Exactly. Those policies could jumpstart the economy, but also potentially ignite inflation. It is a delicate balancing act for the Fed.
Trump's stance on tariffs has been a source of uncertainty, especially given conflicting reports about his potential policies. Some analysts believe tariffs could protect American jobs, while others fear they could spark a trade war with global repercussions. Should investors be factoring the risk of a trade war into their decisions right now?
The possibility of a trade war is certainly a wild card. Tariffs are a complex tool with the potential to both help and hurt the economy. They can shield domestic industries in the short term, but could lead to higher prices for consumers and retaliatory measures from other countries.
Let's shift our focus to the tech sector for a moment. Nvidia, a major player in the chipmaking industry, saw its stock jump 1.6% after unveiling new products and partnerships at a recent tech conference. Do you think this positive response signals good things for Nvidia and for the tech sector in general?
Nvidia's stock surge indicates that investors are excited about the company's future prospects and its role in key technology trends like artificial intelligence and gaming. This enthusiasm could spill over into the wider tech sector, which has been a powerhouse of innovation and growth.
Micron Technology, another big name in the semiconductor industry, also got a boost. Their stock soared 5.4% after Nvidia announced a partnership with them to provide memory for advanced gaming chips.
That was a big announcement.
This partnership, coupled with Micron's impressive stock performance, seems to paint a rosy picture for the semiconductor industry. What is your take?
The Nvidia-Micron partnership highlights the growing demand for advanced memory solutions driven by data-intensive applications like gaming and AI. Micron's stock jump reflects investor confidence in the company's ability to ride this wave. It is a strong signal for the overall health of the semiconductor industry.
Aurora Innovation, a self-driving technology company, stole the show with a whopping 44.4% stock surge. This came after they announced a partnership with Nvidia and Germany's Continental to roll out driverless trucks on a large scale. Does this three-way collaboration signal that the era of autonomous vehicles is finally upon us?
This is a major step forward for autonomous driving technology. The partnership combines expertise in artificial intelligence, computing, and automotive manufacturing.
What does the market's reaction tell us?
The stock market's reaction shows growing confidence in Aurora Innovation's ability to lead the charge in this rapidly evolving market. The fact that Continental, a major player in the automotive industry, is on board further solidifies the shift towards the real-world application of autonomous technology.
This partnership is fascinating but raises a lot of questions. Are we really ready for driverless trucks on our roads? What are the implications for the trucking industry and the millions of truck drivers whose jobs could be affected?
The potential impact of autonomous vehicles on jobs is certainly a valid concern. We also need to ensure that the technology is safe and reliable before it becomes widespread. There are regulatory hurdles and ethical considerations to address as well. It'll be interesting to see how those issues are addressed.
It certainly will. This level of disruption in an industry as large as trucking raises a lot of questions about how we prepare for the future of work. But before we get too deep into those societal implications, let's bring it back to the current market landscape. With all these factors at play, how should investors be navigating this volatile and uncertain terrain?
Investors need to be strategic and nimble in this environment. Diversification is key. Spreading investments across different asset classes can help mitigate risk. So can investing across different industries and geographic regions.
Given the tech sector's strong performance recently, it seems like investors are still bullish on technology-driven companies. Should we be adding more tech stocks to our portfolios, or is there a risk of overexposure?
Tech remains an attractive investment destination, but it is important to be selective. Investors need to look beyond the hype. They need to consider factors like regulatory changes, geopolitical risks, and competition within the industry.
ESG investing is gaining momentum. For those who don't know, ESG stands for environmental, social, and governance factors. Does this trend align with the current economic and technological shifts we are seeing?
ESG considerations are becoming increasingly important for investors. Investors are recognizing that sustainability, social responsibility, and good corporate governance are not just buzzwords. They are factors that can impact long-term value creation.
Can you give an example?
Sure. The shift towards a more sustainable economy driven by innovations in renewable energy and electric vehicles presents interesting opportunities for investors.
The Federal Reserve's monetary policy decisions can make or break the market. With all the conflicting signals about their next move, how can investors decipher what the Fed is likely to do?
Investors need to keep a close eye on several things: economic data, inflation trends, and statements from Fed officials.
So how do we know what they'll do?
The Fed's decisions are data-driven. They will likely adjust their course as the economic picture evolves. This means investors need to be prepared for potential volatility and position their portfolios accordingly.
The incoming Trump administration adds another layer of complexity. What are the key policy areas investors should be watching closely as the new administration settles in?
There are several: tax policy, trade policy, and regulatory changes. All of those areas could have significant market implications. Investors need to stay informed about developments in these areas and analyze how they might affect their investments.
Trump's proposed tax cuts have been a hot topic. What are the potential ramifications for businesses and investors if these cuts become reality?
Tax cuts could boost corporate profits and stimulate economic growth, but the devil is in the details. The specific provisions of the tax plan and its long-term impact on the economy will ultimately determine the true effect on businesses and investors.
Trump's stance on trade, particularly his talk about tariffs, has some people worried about a potential trade war. How should investors approach this uncertainty?
Trade policy uncertainty is a breeding ground for market volatility. Investors need to carefully assess how potential trade disputes might impact the companies and industries they are invested in. Diversification across different markets can help mitigate risks tied to trade tensions.
Deregulation is another area that has investors buzzing. What are the potential upsides and downsides of deregulation?
Deregulation can be a double-edged sword. It can reduce compliance costs for businesses and spur economic activity. On the flip side, excessive deregulation can lead to unintended consequences, such as environmental damage or financial instability. Investors need to be discerning. They need to consider the specific areas targeted for deregulation and their potential impact.
It sounds like investors have a lot to juggle right now. We have economic data, the new administration's policies, technological advancements, and the global economic backdrop. How can they effectively navigate this complex web of information and make smart decisions?
Staying informed is key, as is diversifying investments. And maintaining a long-term perspective, seeking advice from financial professionals can also provide valuable insights and guidance.
The convergence of economic, political, and technological forces is creating a truly unique landscape. It will be interesting to see how these trends unfold and shape the future.
We are at a crossroads. The decisions made today will have a profound impact on the trajectory of the global economy.
The global economic landscape is in constant flux. How do these global trends intersect with the domestic economic and political developments we have been discussing?
The global economy is like a giant spiderweb. A tug on one strand can send vibrations throughout the entire structure. Developments in one region region can trigger ripple effects across the globe.
Like what?
The threat of a trade war, for example, could disrupt global supply chains and stifle economic growth worldwide. Investors need to be mindful of this interconnectedness and factor geopolitical events into their decision-making.
Emerging markets are often seen as high-risk, high-reward investment destinations. How should investors approach these markets in the context of the current global economic and political climate?
Emerging markets present both opportunities and risks. Some emerging economies are experiencing rapid growth. That offers the potential for substantial returns. However, these markets can be volatile. They are often subject to political instability. Investors need to carefully assess the risks and rewards before venturing into these territories.
China's economic influence is undeniable. How does China's economic trajectory impact the U.S. economy and global markets?
China's economic rise has been a major force in global economic growth over the past few decades. However, China's economy is currently undergoing a transition. It's shifting from an export-driven model to one focused on domestic consumption.
What does that mean for the U.S.?
This shift could have a significant impact on global trade patterns. It could lead to increased competition for U.S. businesses.
The race for technological supremacy is a global phenomenon. Countries around the world are pouring resources into areas like artificial intelligence and autonomous vehicles. How is this competition shaping the economic and geopolitical landscape?
Technological innovation is a key driver of economic growth and competitiveness. Countries are vying for a technological edge.
How so?
They're investing heavily in research and development. This competition is likely to accelerate advancements in fields like artificial intelligence, biotechnology, and renewable energy. We can expect to see groundbreaking innovations emerge from all corners of the globe.
We have covered a lot of ground today. From the Federal Reserve's next move to the implications of a potential trade war, there are many factors shaping the economic and technological landscape. What are the most important takeaways for our listeners?
It is a time of great change and uncertainty. The economic and technological forces at play are creating both opportunities and challenges. Staying informed is crucial. So is being adaptable and maintaining a long-term perspective. It's all essential for navigating this dynamic environment.
Anything else?
Understanding the interconnectedness of global markets is important, as is the potential impact of technological disruptions and the evolving political landscape. It's all essential for making sound decisions.
The future is unfolding before our very eyes. Those who can embrace innovation, adapt to new realities, and navigate the complexities of the global landscape will be the ones who thrive.
It is an era of unprecedented transformation. The decisions we make today will shape the world of tomorrow.
Until next time, goodbye.